In this video, we're going to talk about how to account for uncertain tax benefits. So an uncertain tax benefit arises when your company is not certain that its tax position is going to be sustained by the taxing authority. So let's say, for example, you're a firm in the US and you take a tax deduction that you're not sure 100% that the IRS, which is the federal taxing authority, is going to allow that tax deduction. So there's some uncertainty there, and then the question is, how much of that benefit should your firm recognize in the financial statements? So there's a two-step test that we use to figure out how much benefit is recognized. So first step is we say, okay, is it more likely than not? And by more likely than not, we mean a likelihood of more than 50% chance, right? So is there a greater than 50% chance that your tax position, for example, a deduction, will be sustained? Okay, so if you say, look, there's only a 10% chance that the IRS is going to allow this deduction, you don't get to recognize any of the tax benefit, okay? But if it's a greater than 50% chance, you do get to recognize some of the tax benefit. But the question then is, how much? How much of the tax deduction, how much of the benefit from that tax deduction do you get to recognize in your financial statements? And the answer is that it's the largest amount of benefit that is cumulatively greater than 50%. That's very abstract. Let me show you with an example. I'll put together a table and it'll make it a little easier for you to understand. So let's say your company has pre-tax book income of $1 million. Okay, now your company, that included a tax deduction that your company took of $200,000. And so your tax attorney for your firm says, look, we have a 75% chance that some of our tax deduction will be upheld, right? So there's a good chance here. It's more than 50% chance that the deduction is going to go through. So we say, okay, step one has been met. Then we can go to step two. If we didn't meet step one, if this was 10% or 20%, then we're not going to get to recognize any of that tax benefit because it's like it's far too unlikely. We shouldn't be recognizing that. But 75% chance, so we're good to go with step one. Now we have to do step two. Okay, so, and by the way, our tax rate for the company is 40%. So what we're going to do is we're going to set up a table. And you would get all the information from a tax attorney, from your company's tax lawyer. So you go and you say, okay, what are all the different possible outcomes? And by possible outcomes, I'm talking about the value in dollars or euros or whatever of the different outcomes that you could have. For example, let's say, so we've got a deduction, if you see here, $200,000 and a tax rate of 40%. So if the IRS upheld the entire tax deduction, if we got the full $200,000 that went through and there was no problem at all, if we multiply that by 40%, that gives you $80,000. So the best possible outcome is $80,000. This is if we had the full $200,000 deduction was unchallenged. $200,000 times 40% is $80,000. Okay. Now, our tax lawyer says there's a 15% chance that we will get this outcome. So that is the individual probability. And so what we can do is from the other numbers that we get from the tax lawyer, we can go and say, okay, there's also a chance that we won't get the full $80,000 of tax benefit, but we could get $70,000, we could get $65,000, we could get $50,000, or we could have zero, right? So these numbers are going to come from the tax lawyer. So I just made these numbers up to give you an example. So you don't calculate them, they're going to be given to you. And we can come up with the individual probability for each of these outcomes. So there's a 10% chance that the outcome will be $65,000 worth of tax benefits, okay? Now, once we have the individual probabilities, we can calculate the cumulative probability. So the cumulative probability is just saying, okay, for 80,000 for the very first one, it's going to be the same as the individual probability. But for the second one, for the 70,000, and notice I put them in descending order here, right? So it goes 80,000, then 70, 65, it's going lower. You'll see why in a second. So is 15% is the same for the first one. But for the 70,000, we're saying, okay, the cumulative probability, we don't want just the probability of the 70,000. We also want the probability of the previous outcome of 15%. So 15% and 30% together, if we add them, is 45%. Now, for the cumulative probability for the 65,000, again, we don't want just the 10%. That's the individual probability of us getting $65,000 worth of tax benefits. We want the 10% plus all the probabilities that come above it, okay? So if we add 15 plus 30 plus 10, that gives us 55%, okay? Now, when we look at the cumulative probability for $50,000, again, we take everything, we take the 20% plus everything above it. So we've got 15, 30, 10, and 20. That gives us a cumulative probability of 75%, and then we have a 25% chance of getting nothing. We add all these together. That's a cumulative probability of 100%. Now, we look at this cumulative probability column, and the very first time that we exceed 50%, okay, so the first time where it's cumulatively greater than 50%, which would be right here, that's how much tax benefit we're going to recognize, okay? So in this case, we would recognize a tax benefit of $65,000. Okay, so you notice here that the maximum we could have had was $80,000, right? If we got the full deduction of $200,000 at a tax rate of 40%, we would have had $80,000. But we're only going to recognize 65. Okay, so there's a gap there of $15,000. The $80,000 minus 65 is $15,000. So what we're going to do is we're going to set up a tax contingency reserve account, right, which is a liability account to recognize the fact that, hey, we're probably not going to get the full $80,000 of this deduction, right? We're not sure what's going to happen, but based on this two-step test, we're going to have $65,000 of benefits. So we've got to account for that difference between 80 and 65. So I want to show you the journal entry that'll show you how this works, okay? So before I actually, let me kind of talk about this in reverse order. So let's leave aside tax expense and tax payable for a minute. So the tax contingency reserve is going to be credited, and it is a liability account. Okay, so this is a liability. It's a liability. So this tax contingency reserve, and it's also sometimes, you might see liability for unrecognized tax benefits. So we're crediting it for $15,000. Okay, and the reason is we're just taking, like I said before, taking that $80,000, which is the maximum benefit we could have got, minus the $65,000, which is what we're going to actually have on our financial statements. Okay, remember we got $65,000 at 80. And so we're saying, hey, we don't think we're going to get the full thing, so we're going to credit a liability account here. Why are we even crediting a liability account? Because the check that we cut to the taxing authority, let's say the IRS, is actually $400,000. And why? Because when we filled out that tax return, we filled it out assuming we'd get that full $200,000 tax deduction, right? So we just said, okay, $1 million, which was our pre-tax book income, right? And we'll assume that it's also our taxable income and so forth here. They're the same thing. But we have $1 million times the tax rate of 40%, okay? So this $1 million was incorporating that full $200,000 tax benefit as if we were going to get the $80,000 of tax benefits, okay? But we know that that's not probably going to be the case because we say, look, we've done this two-step test. Reality, we're going to have to pay maybe more than this $400,000, right? So this $400,000 is the check we cut to the tax authority. But in reality, we're probably not going to get that full deduction. So we're going to create another liability account here, this tax contingency reserve. Now, if you add these two together, you have income tax expense of $415,000, okay? And now all we're doing with that is we're saying, look, we cut a check to the IRS for $400,000, plus we've got to say that we're probably going to have some additional tax liability because we took an aggressive position. So we add those two together, and that gives us our income tax expense of $415,000.